Hello, everybody, and welcome to another installment of our Southern California housing market update. I am your host, Stephen Meade. I'm the managing broker here at Domicile Real Estate for people who love houses. Kind of an interesting week. I think one of the reasons why we do these weekly, I know a lot of real estate agents like to give out information like this on kind of more of a monthly basis. I think in a fast moving market, I actually don't think that is fast enough. I think you need to be a little bit more on top of watching how those market dynamics change, because they do in fact frequently change pretty quickly. And we're coming out of a holiday. This period of time between Thanksgiving and probably New Year's is kind of known as the deadest period of time in real estate in Southern California, typically. This year is a bit different, and this year is different in a lot of ways just because we are so low in terms of the amount of inventory that we have. We're just not really in a position to kind of have that inventory build up and languish, which is normally what happens around this time of year. If you don't have a house that's hot on the market, it will typically sit during this time of year. And our advice normally to buyers, normally to sellers, is if you've got a property like that isn't going to be this attractive move mountains kind of a property, you're usually better off waiting until January. I don't think that advice is true this year, but we have kind of some interesting dynamics going on, and I wanted to take you through those. So let's go ahead and do that. Okay, so total active listings, right? One of the things that we have talked about multiple weeks now is this kind of march of active inventory taking a dive. Well, it's funny, it leveled out. And I actually think there's a couple reasons for that. Number one is I think for every house that didn't come on the market the week of Thanksgiving, those sellers probably waited and put their houses back on the market this week. So I'm not entirely sure, or at least over the last 2 weeks. I'm not entirely sure that that's the case, but I have a high probability that that's what's going on a little bit. It's a little bit of kind of a reaction and a rebound. And we can actually measure that in some way, though, by looking at this. What is our 14-day new listings, right? And while I wouldn't call this a rebound, this is a pretty strong reversal, right? New listings had been slowing down, and then it kind of just it sort of hockey sticked a little bit here. And this is both in our under $1 million and our $1 to $2 million categories. And I think it's kind of important to take note of that. And I'm really curious what's going to happen next week. Are we going to see kind of a continuation downward, or are we going to just see that this is the low point we're going to see for the next few weeks until we hit the new year, when typically those listings will come up? So kind of watch this space. I think a good amount of this is a reaction to that. So if you were to draw kind of a trend line, normally we'd be about here maybe. I think we're going to see kind of more of that trend line. It'll sort of return to where it would have been had we not had the holiday. I don't think the holiday means listings go away. I think it means listings are delayed. But now if we look at our new escrows, we see something kind of interesting. These didn't rebound in the last week. And, there's a couple reasons why that could be, right? I mean, this is interest rates have gone up. I think that's part of it. I think most buyers are a little frustrated. Maybe they want to spend some time with family. There's a couple reasons for this, but again, I'm also very curious to see what's going to happen in the next week. Are we going to see a reversal on this, or is this kind of our new level of demand? And if it is, that's kind of something interesting, right? Remember, this is escrows in the last 14 days. We are still including part of that Thanksgiving week in this 14 days. Also, just a reminder for everybody, this is Los Angeles and Orange counties. I know this is the Southern California housing market update, but understand that we do a lot of focusing on our statistics, at least in LA and Orange counties. San Diego actually tends to be somewhat similar. The inland counties can be a little bit different. So if you have questions about those, definitely ask specifically, and we can maybe help get you some answers. And then if we look at this absorption rate, right, like these took a dive. So if we go back here, right, what did we have? Just under 2,000 new listings for our under $1 million, and maybe about 800 new listings for our $1 to $2 million. What did we have? Right about 2,000 homes went into escrow, and maybe around the same amount, 800 here. So what does this mean for our absorption rate? Well, it means our absorption rate did come off of its highs, but I want you to have a little bit of perspective here. This was our absorption rate through the spring right here in this under million, right around 90%, maybe going up a little bit. It's spiked and it's come down, but we are still over 100%, meaning more homes went into escrow than came on the market. And I want people to see that and understand that, because that's kind of a fundamental thing that people need to kind of understand, right? We've halted the drops in inventory temporarily, perhaps, but we haven't gained any ground, right? Like, it's not like there's suddenly more houses sitting. It's just we have lessened the bleeding, as it were, of active listings. Now, this is one that I want to talk about too, because if you'll remember when we talked maybe about 2 weeks ago, these diving prices were a bit of a concern, right? Like, for everybody, I think, and I said, hey, it's not what it looks like. This is a bit of an artifact of our data collection process and how we tabulate the results. And sure enough, look at where these prices have gone. They've all rebounded right about back to where we were. And if you look at this upper end, maybe a little bit of price growth here, especially in this last couple months, maybe a little bit of growth here. You can see this graph kind of trending upward, and kind of a bit more graph, especially as a growth, especially as a percentage on the low end, these 25th percentile entry level type homes in the marketplace. And you can see the prices that correspond with these charts here. Now, this is one that I think bodes particularly well for buyers. But again, I want to caution people just a little bit. I do think there's a little bit of holiday artifacting going on in here. This is still active after the last this is the percentage of homes that came on the market in the last 14 days, which, remember, does cover Thanksgiving. What percentage of those is still available? Well, what happened? We had none about 14 days ago, and in the last 5 days, tons of houses have come on the market, right, in the last week. So, this is going to skew this a little bit higher, but I'm curious. I think we might be heading up just a little bit in general. I think we are a little bit quieter right now than maybe we were 2 or 3 weeks ago in the market. Maybe. We'll see next week, but that's kind of where my gut feels on this. If you look at our close to list ratio, this has been pretty stubborn in a lot of ways. I would have expected that by the end of the year, we would have been getting down more towards this 100%, or on average, homes selling for their list prices, but we haven't really. And in fact, you could even argue in this 1 to 2 million, we've kind of hovered in this 102, 103% range. Same thing for our under $1 million. That's unusual. When you look back here towards the end of December, we were much closer to that 100%, and then things went through the roof in the spring. This is still a pretty robust market. Again, though, remember, this is taking a look back 4 to 6 weeks ago, because this is based on closed sales, not on homes that just went into escrow. Now, this one is fascinating to me, because I want to watch this space. One of the things that we've been talking about, and doing this a lot, is comparing to last year and sort of benchmarking. How do we look in December? Well, in December, what was the average days on market for homes that went into escrow? Well, it was 55 days for our 1 to 2 million, and it was like 38 days or so. We have finally seen some actual real appreciable gains in this. Again, some of this might be a little bit of artifacting due to the holiday, but not all of it. And it makes me wonder, we're going to see this number climb up back to where it was. I don't think we'll get to where we were at the end of last year, but I do think we're going to see these finally start to rise a little bit as we race towards the end of the year. And then, as you can see in this graph, what happens in the spring as we go to January, these numbers start to go back down again. That's our pretty typical pattern. I don't see a reason for that pattern to not exist this year. I just think the amplitudes might be different. I don't think we're going to get back to 55 days on market by the end of the year for 1 to 2 million. Now, looking at our affordability chart, one of the things that I had talked about last week was that we were kind of cresting towards this 120%. And remember, just as a reminder of what this means, we looked at what was the payment on a median priced home back in June of 2018. We kind of hit that as our baseline, our 100% number. So everything is relative to that. and we hit 119.5%. I said, wow, that's a change. But look, we've actually come back down a little bit. I'm comfortable with this being, if you look at the slope, right, of this curve through 2021 through the spring. I mean, look at how fast those payments rose. Then they got into this 110 to 115% range, and they've really kind of stagnated a bit. I would expect to see some of what I've called on a couple times here inflationary level price growth. And I think if you kind of draw this graph, that is probably about where we've ended up. Like I said, I think if this number starts to go above 120%, starts to really accelerate, then I start worrying a little bit about where are we in relation to wages? Where are we in relation to rental prices? These are all factors, that indicate something. I'm going to go off screen share here for a second. One of the things I've talked about on several occasions is the difference between rational market behavior and irrational market behavior, right? The market of 2007 and 2008 in real estate, I would call an irrational market. You had people who were essentially buying on speculation, right? Buying on I was going to say belief, but I'm going to say hopes and dreams, prayers, maybe even, that the market was going to continue to go up. They didn't actually have a use for these houses. People were putting deposits on new construction homes with no intentions of ever living in them. That's all the mark of the irrational buying behavior, right? Like people are buying on kind of a belief and a hope, rather than on kind of any fundamental sound market decision. So when I look at this chart, that's what I'm trying to determine when I'm looking at this is I want to know, when do we cross that threshold of being in an irrational market, and when are we just seeing consumers still making very reasonable choices, right? I think if you look at what rents have done, I think if you look at inflation of other goods, I don't think that being at, we'll call this 117% or 17% higher than we were 3.5 years ago is an unreasonable situation to be in payment wise. I think that's actually a pretty reasonable scenario. And when I see this number jump quickly, that scares me a little bit. We backed back down a little bit. If you drew a trend line, it's not super scary, and it's way less steep than we were in the spring. So, I'm spending a lot of time on this because really it's important to kind of watch this space and have an understanding of what's happening. One of the things that I think I might want to do next year is overlay an inflation graph on this so you can see inflation, what's been happening with the CPI over this point in time, because I think it's important to kind of track that a little bit and kind of see where we are in tracking with kind of overall market inflation. One more chart for you, prevailing mortgage rates. If you look at this graph, this is actually pretty steady. And I've talked about this a billion times before. I'm going to say it again. What's more important to me than where mortgage rates are or end up is how long it takes them to get there. Our market has an amazing ability to absorb some of these increases if they're done slowly over time. I think when you see, rates shoot up really quickly, and I mean, if you look here, they did move, right? Like from the end of September to, about where we are now. I mean, yeah, this has been some movement, but I'm going to put some numbers here for you. This is like going from like 2.9% to 3.1. I think over a 2.5 month space of time, I don't think moving less than 0.25% in interest rates is that big of a movement over that period of time. I also think with the new Delta variant, with some of these other worries on the horizon, that's tempering, some of that fear that our economy is overheated. And an overheated economy, that's one that people get a little bit nervous about. The rates can run up kind of quickly in that situation. I think that what we're seeing here is there's actually a little bit of a tempering of expectations about the future. That things aren't going to run at an unsustainable pace, that we might pull back even a little bit. And I actually think that makes the bond market a little bit more comfortable to see that behavior. And that's why we're seeing the rates kind of now hovering around this sort of 3.1 zone. Anyhow, I hope everybody's having a great holiday season. I know you're probably out there thinking about buying presents if you celebrate Christmas or gatherings or holiday parties and lunches. But if you're a buyer out there or a seller out there, this year is unusually good for you. I normally can't say that. If you're a seller, the calculus you're doing is, do I wait until January because I think prices are going to go back up? The problem with that is if you're buying another house, that's kind of a zero-sum game. The other is, if interest rates do move, there's that risk that you lose some of that buyer velocity. If you're a buyer, guess what? This week was a little calmer. I think this is good news for you. It's definitely not a bad place to be a buyer, relatively speaking, to other weeks in the year. This has always been my personal favorite time of the year to represent buyers, because frankly, it's almost always a little bit easier. I wouldn't call this year easy by any means. We still have limited inventory. There will still be multiple bids on the most desirable houses, but I think you might have a little bit less competition in the next couple of weeks than you would have had maybe a month ago, and that can be a good thing for you. Anyhow, thank you everyone for watching. Questions, comments, we love them. If you need help buying or selling a property in Southern California, we would love to hear from you, help you, and lend our expertise. And finally, do not forget to like, subscribe, and hit that notification bell. We will see you later on this week for another one of our architectural videos. We are going to start doing those again. We love doing those. We'll see you again on Thursday.